Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Uber.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis of Uber. I think the primary takeaway here for you, the learner, is that this is just not the same company it was a few years ago.
The venture capital experiment phase is over.
Exactly. The story has pivoted. Uber has moved firmly past its cash-burning phase and is now executing as a high-growth, and this is a key word, profitable platform.
And that structural shift is fundamental, isn't it?
Right.
We spent years talking about potential scale, and now we're actually talking about real, verifiable financial performance.
We are.
So to anchor this, what were the absolute standout numbers from the most recent quarter, Q3 2025?
Well, the health of the business is really clear in both the size and, I'd say more importantly, the quality of the revenue growth. Revenue hit about $13.5 billion. That's durable 20% year-over-year growth.
And for a company this big, 20% is. That's a significant achievement.
It really is. But if you just see revenue rise, you have to ask.
Right. Is this just inflation? Or is underlying demand actually accelerating? Are people really taking more trips?
And that's where the numbers get, frankly, staggering. Trip growth actually accelerated to around 22% year-over-year.
22%.
That is one of the largest trip volume increases in the company's history. Think about that. They are already massive, and yet their fundamental usage is speeding up.
It's like a supertanker turning into a speedboat.
It is.
And drilling down into the mobility side, was that just driven by higher prices?
No, and that's the key indicator of sustainable demand. In mobility specifically, the trip growth was all volume-driven. Pricing actually stayed flat.
So it's not being artificially inflated. This is real, persistent demand. Okay, so top line is healthy. Usage is accelerating. Now, let's talk about the promised land, profitability. For years, the thesis was that eventually, scale would deliver this massive operating leverage. Is it finally here?
It absolutely is. And you can see management's confidence in their targets. Adjusted EBITDA.
Right. The earnings before interest, taxes, and all that. A good measure of operating profit.
Yes. It's now consistently above $1.2 billion per quarter, and that's happening alongside that high teens revenue growth.
$1 billion here, $1 billion there. I mean, that starts to look like real money.
It does, but what's even more insightful is the framework they've set. They're targeting adjusted EBITDA growth at more than 2 times gross bookings growth.
So costs are growing at less than half the rate of the money coming through the door.
Precisely. That is the ultimate signal of operating leverage. It shows real, meaningful efficiency gains.
We all know the company's history of burning capital. Has this turnaround, fully de-risked the balance sheet?
Materially, yes. The company is consistently generating meaningful free cash flow now.
And that's the cash left over after everything's paid for.
Yeah.
It's the true measure of a business being self-funding.
It is. And that financial strength, it gives them immense optionality. They can fund their autonomy research, they can do buybacks, they can reinvest aggressively.
So the financials are solid, the foundation is set. Let's shift gears a bit and look at the long-term defensibility. I mean, what is Uber's structural moat?
The moat is really anchored in sheer global scale and liquidity. It's the network effect.
Right.
We're talking about a two-sided network with, 9.4 million drivers and couriers? That workforce earned about $22 billion in Q3 2025 alone.
And that liquidity means shorter wait times, better pricing. Things a regional competitor just can't match.
They can't, but the real long-term leverage is using that scale across both business lines, mobility and delivery.
That's the cross-platform opportunity.
Exactly. It's their single largest embedded growth lever. We know that consumers who use both mobility and delivery spend about 3 times more.
3 times.
And have 35% higher retention. They are incredibly sticky, high-value users.
Okay, that sounds compelling, but here's where I have to push back a little. Only about 20% of their eligible monthly active users actually use both products.
Right.
So why is that an opportunity and not, a massive failure in cross-selling?
Yeah.
Why haven't they converted the other 80%?
That is a crucial, critical question. The reason it's seen as an opportunity is that it means the company's growth isn't reliant on finding millions of brand new users. That's expensive.
Okay.
Instead, they have this massive captive audience, that 80% who already trust the brand, has the app, has their credit card saved. It's an internal growth market.
So it's low-hanging fruit.
On a massive tree. Converting just a fraction of them provides years of built-in revenue acceleration without huge new marketing costs.
That does frame the growth story much more powerfully. Now let's talk about the delivery segment. It
Mhm.
seems to be morphing from just a food business into a broader local commerce platform. What's driving the margin expansion there?
It's two things: better monetization and diversification. Delivery revenue grew around 29% year over year, which outpaced booking growth.
And the monetization part is advertising.
That's the key. Advertising is this high margin layer that just scales on top of existing demand. They added about $146 million in incremental ad revenue in Q3.
And that flows almost directly to the bottom line, since the platform is already there.
It's virtually pure profit growth.
And the diversification. I heard a huge number about grocery and retail.
That's the second powerful trend. The grocery and retail, or GNR vertical, is now running at an approximate $12 billion gross bookings run rate.
12 billion.
To put that in perspective, it positions Uber as a truly global royalty layer on local commerce. That's the domain of giants like Amazon and Walmart,
And the fact that it's growing faster than restaurant delivery shows they're expanding their whole market.
far beyond just quick meals.
Yes.
And if we connect all this strength to the bigger long-term picture, the ultimate lever for profitability is reducing the largest variable cost, the driver.
Which leads us directly to autonomy. How are they executing that strategy? Are they back to building the incredibly expensive hardware themselves?
No, and that was a very painful lesson learned several years ago. They are using a remarkably smart, asset-light, hybrid human autonomous marketplace approach.
So they aren't building the cars.
They are not. They're pursuing partnerships, like with WeRide. This model reduces their capex, their risk, and it lets Uber remain what they are best at.
The demand aggregator. The brains, not the brawn.
Precisely. They collect a royalty on the movement without taking the ownership risk, and we're already seeing this validated in Dubai with the launch of autonomous robotaxis.
And the local authorities there support it.
Fully. They have a goal of 25% self-driving trips by 2030. It's a massive proof point.
So what's the time scale for this becoming a meaningful part of the business?
Their stated goal is ambitious, but it's clear. Be live with AV deployments in at least 10 cities by the end of 2026.
10 cities by the end of 26. If they hit that, it really accelerates the timeline for lowering costs.
In high-density areas, absolutely.
Okay, so the fundamentals look stellar. Accelerating usage, expanding profits, huge cross-platform potential, and a smart AV strategy. And yet the stock recently pulled back by about 10%. Why the disconnect?
This raises the essential question, doesn't it? The decline wasn't driven by any company-specific fundamental issue. We just outlined how strong those are.
So it was external factors.
Exactly. Broad regulatory headlines, which always spook investors in this space, and just general macro sentiment. The market tends to shoot first and ask questions later.
So from a technical perspective, how should you, the learner, view this? Is this a broken trend or a buying opportunity?
Technically, the price is still trading comfortably above its long-term 200-day moving average. That's a classic sign of a structural uptrend. This consolidation looks very much like a buy-the-dip setup.
And you're seeing institutional interest that backs that up.
We are. Strong smart money sponsorship.
Yeah.
You have Lion Trust increasing their stake, North Dallas Bank initiating a new position. That's a strong signal.
What about insider activity, though? We've seen headlines about executives selling. How should we contextualize that?
Yeah, you're right. There has been net insider selling. The CEO and CFO sold around $26.77 million in shares recently.
Which looks bad on the surface.
It can, but you have to view it in context. After a multi-year run-up like this, a certain level of executive selling is normal. It relates to compensation, vesting schedules, personal diversification.
So not necessarily a lack of confidence.
It's rarely interpreted that way, especially when institutional buyers are stepping in at the same time. But we absolutely must address the risks that created this pullback, because while the thesis is strong, the headwinds are real.
And what's the biggest source of drag on sentiment right now?
The dominant headwind is regulatory risk. Specifically in markets like Europe, the ongoing pressures around driver classification, platform liability, these are constant sources of uncertainty.
And if those regulations get implemented broadly, they could increase operating costs and hit those margins we just talked about.
That's the fear. And tied into that is the reputational risk.
Right, for managing a global fleet of millions of drivers.
Exactly. Incidents like the alleged anti-Semitic incident in Toronto, while hopefully isolated, create brand and safety risks. And from an investment perspective, they invite the exact regulatory scrutiny that increases costs.
And finally, let's revisit competition risk with autonomy. If partners like Waymo or WeRide push their own brands, could Uber get cut out?
That is the autonomy bear case. Yes, the platform partner suddenly becomes a direct competitor. It's a structural risk of disintermediation.
What's the strongest counterpoint to that?
The counterpoint is Uber's scale and its relationship with the consumer. It remains the natural demand aggregator. It controls the customer's journey from A to B.
So it can charge that royalty on movement, whether it's a human driver or a robot.
They control the consumer, regardless of who owns the hardware. That's the moat.
So what does this all mean for you, the learner? We've analyzed a company that has fundamentally shifted from a speculative growth bet to a profitable, free cash flow generating global compounder.
It has expanded its market through ads and local commerce, and the current headwinds seem largely tied to manageable sentiment and regulatory concerns.
The immediate focus then is on execution.
Yes. The primary near-term catalyst will be the Q4 2025 results. Analysts are looking for continued high teens revenue growth and further adjusted EBITDA expansion.
And a beat and raise there would probably clear up a lot of this recent uncertainty.
It would likely alleviate much of the sentiment overhang, yes.
And what other catalysts should we watch for?
Look for updates on that 10-city AV deployment roadmap and continued expansion in that faster-growing grocery and retail space. Every successful partnership there strengthens the long-term thesis.
It sounds like the risk-reward is currently compelling, offering an opportunity to accumulate a structurally strong platform name, especially given the recent pullback was driven more by sentiment than fundamental weakness. If you found our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.